Capital adequacy for IFAs. Now, the source of the rules is in the handbook, the FCA handbook. It's chapter 13 IPRU. You've got to have 20,000 of capital, or if your turnover is more than 400,000, 5% of your turnover at all times, and it's not cash in the bank. What you need is an accounting system, something like Xero. There's also QuickBooks, there's also Sage, something you can tap into and get a balance sheet at the press of a button like this. The key part is net assets. At the bottom, that number has to be plus 20,000. Okay, so I'll come back to that. PI is a function of capital adequacy. You've got to have, if you've got a liability, PI will pick it up. But the first is a liability. And the liability, if you owe somebody some money or you've been sued and you may have to pay a proportion, needs to be put into the liabilities column. But equally, if you're going to recoup that from PI, that can be put in as a debtor in accounts receivable. There's some extras for IFAs. Exclusions on your PI insurance will mean you need to hold extra capital and also a higher excess on the PI. If you've got ARs, include their income in full, their regulated income. So include debtors, as I've mentioned, there. Now, if you don't have 20,000 in the bank, that's fine, as long as you have that as an account receivable there, and it's available probably within 30 days, certainly within 90 days. That's the sort of thing your accountant will get involved in. And of course, you have to treat creditors in much the same way. Creditors meaning money that you owe to other people. So if you've got a big bill coming up next week, you can't just pretend it doesn't exist and put in a higher capital adequacy return, a higher balance sheet return. It's there and it's on the balance sheet and you need to recognize it. You can also include own funds, assets that can be realized within 90 days. And that goes in the top column. That's normally cash in the bank. So you need the accounts within 6 weeks of the year end. As I said, you need an accountant, you need a system, and you need to pass at all times. And it's essential that IFAs understand this, because the general knowledge base for IFAs is relatively low, given that they're called financial advisors, but you don't have to fill out VAT returns, you don't have creditor problems, and the industry generally is slower than normal tradesmen like shopkeepers. So get up to speed, and if you've got any questions, talk to Alistair Frame.